Hi everyone, my name's Abul. Welcome back to CRTV, powered by City Realtor. Today's video has been our most highly requested topic, requested by a staggering one person. How is capital gains tax worked out for properties sold in the UK? Throughout the video, I may refer to capital gains tax as CGT, as it's a very commonly known acronym for it. I want to preface the video by saying this is going to be accurate to August 2023. However, this is from my personal experience and knowledge and research, so if you are trying to work out your own personal CGT, please get a qualified accountant to do that for you. I'm going to try and keep this video quite simple. This kind of thing can get quite complicated, but we're going to look at just the main parts. First of all, let's explain what is capital gains tax. Capital gains tax is a form of government taxation relating to gains made on the value of assets held for more than 1 year. This can include sales of shares, for example, or sale of a business, or inherited properties and second homes. It can apply to any valuables you might own over a certain value, if you sell them for a profit. This also includes gains made from cryptocurrency sales. However, this video is about CGT on property, so that's the part we'll dissect. So if you buy a property that's your home and is your principal address, and you live there the whole time that you own it, then you are not liable to pay any capital gains tax on the profit that you make from the sale of that property. So let's say you buy a property for £250,000, live there for 5 years, then sell it for £500,000, then you have a £250,000 capital gain that you are eligible to keep all tax-free due to something called the private residence relief. Now, if you buy and sell a rental property, it's not quite the same. So let's use that same property as an example. So the rate of capital gains that you pay actually depends on a few things: the size of your gain, your taxable income, and whether your gain is from residential property or something else. So in this case, you are firstly allowed to deduct £6,000 as a tax-free allowance. This used to be £12,000 up until recent times. Then you can take off your expenses, things like any work you did to the property, the estate agent fees, stamp duty, solicitor's fees, and let's just say that all came up to about £50,000 because you may have done a small refurb or something like that. That takes us down to £194,000. Now, let's say your day job gives you an earning of £40,000 a year. That leaves us £10,000 until we hit the higher tax bracket. Because what happens with CGT on property is that any gain that is made but is under the tax bracket is taxed at 18%, and anything over is taxed at 28%. So in this case, the first £10,000 of that £194,000 will get taxed at 18%, and the 184 remaining will get taxed at 28%. If you are selling other assets which are not residential property, then the rates are 10% for lower rate and 20% for high rate. And 28% of the £184,000 comes to £51,520, bringing us a total of £53,320 capital gains tax to pay for the sale of this property. Now, if you lived at the property for part of the time that you owned it and rented it out for the another part, then you are not fully exempt from CGT. And here's how you work it out. Let's say you lived at the property for 5 years and then rented it out for another 5 years. You will immediately get 50% exemption from CGT. However, on top of that, due to the private residence relief, you also get the last 9 months that you owned it exempt as well. This used to be 18 months, but that was also changed recently. So this brings the exemption to 57.5%. So the way to calculate this is to take the number of months that you lived at the property, which is 60 months for 5 years, then add the 9 months, which brings us to 69 months, then divide it by the number of months that you owned the property, which is 120 months, then times that number by 100. And of course, you can deduct all your other costs like solicitor's fees, estate agent fees, broker fees, stamp duty, and then you apply the previous calculation of either the 18% or the 28% on that value. So that brings me to the end of the video. Remember, get a qualified accountant to assess your individual situation. There may be other things that you can deduct, like losses from another business or something. As usual, I hope that was useful to some of you, especially that one person who requested the video. Don't forget to like, share, comment, subscribe, and I'll see you in the next one.